Hello, students. I hope you're all doing well. Welcome to the virtual world of business studies. Good morning, dear students. A warm welcome to our new session of grade 11. It's a very interesting topic, sources of business finance. So let me introduce this wonderful topic to you. Firms need long-term capital to purchase expensive assets such as plant and machinery, to develop new products, or perhaps to finance the expansion and the diversification program. Now, we first describe the finance function as a function in a business which is responsible for acquiring and managing funds. Sound management of business finance determines the amount of money needed and the most appropriate source from which to obtain it. A firm can raise needed capital by borrowing money, which we call it as debt, or selling ownership, which is termed as equity, or making profits, which is termed as retained earnings. Now, let me move on to the next slide. If we carefully look at this slide, it talks about classification of funds on the basis of ownership. Now, we put them into two broad categories. One is called as owner's fund and the other is called as borrowed funds. Today, in this subtopic, I am going to focus more on owner's fund. Now, what does the owner's fund include? It includes equity shares and retained earnings. Now, students may always have this doubt as to what is owner's fund. Now, it is the amount of capital contributed by the owner, partners, or the shareholders, as the case may be. Issue of shares and retained earnings are the two important sources of a company's finance. Now let me move on to the next slide. Shares are again broadly put into two categories. One is called as equity share and the other is called as preference share. Let me move on to the next slide. Let us talk about equity shares. What is an equity share? So, the capital of a company is divided into a large number of equal parts or units. Each such unit is called as shares. In other words, share is the share in the share capital of a company. The aggregate value of shares is known as share capital. Now let us discuss in little detail about equity shares. The main advantage of issuing equity shares is there is no need for repayment of funds. As owners of the business, shareholders never have to be repaid their investment. Moving on to the next point, there is no need for security. Now what do you mean by this? There is no need to mortgage a company's fixed assets or to offer collateral security for raising equity capital. Moving on to the third point, which is very important, no compulsion regarding dividend payments. Now, how do we explain this? There is no legal obligation of a corporation to pay dividends to shareholders. So a company can invest its income, which is also called as profits, to finance future needs. Moving on to the next point, that is control. The overall control of a company is fully exercised by the owners, who are also called as the shareholders of the company. Moving on to the next advantage, which is trading on equity. Owner's capital is also called as risk capital because it provides the basis of raising borrowed capital. This is known as trading on equity or taking advantage of the equity position of a company. Let's move on to the next advantage, large public issues. A company can raise huge amount of capital by making large public issue of shares. Moving on to the last advantage, which is financial viability. Finally, selling shares can improve the condition of firm's balance sheet since issuing shares creates no debt. A company may also buy back its shares to improve its balance sheet and make the company appear financially stronger and viable. Now you would be thinking, are there any disadvantages of issuing shares? So the answer to this is yes. Let's look at the first disadvantage, alteration of control. As owners, ordinary shareholders have the right to vote for the company's board of directors. Usually, one vote is granted for each share. Issuing new shares can thus alter the control of a firm. Moving on to the next drawback, no tax benefit. Dividends are paid out of net profit after tax. So, they are not treated as tax deductible. Moving on to the third drawback, pressure on management. The need to keep shareholders happy normally puts pressure on management. Consequently, managers commit decision-making errors. Let's move down to the next drawback, which is concentration of control. Now, what do we mean by this? There are generally a large number of shareholders of a large company, but control of it is exercised only by few influential shareholders. Now, let's move on to the next slide, which is very interesting. And here we are going to talk about the preference shares. Now, you would say, what is a preference share? So, a preference share is one which carries certain preferential rights with regard to the payment of dividend at a fixed rate during the continuance of the company and repayment of capital on the winding up of the company. Therefore, the capital raised by issue of preference shares is called preference share capital. Now let us look down into these preference shares and see what are the advantages of preference shares. Now, the first advantage would be widening capital base. Since most people who prefer safety of their investment along with a fixed rate of return on it, the issue of preference shares evokes considerable response. This enables the issuing company to widen its capital base. Second advantage, benefit to equity shareholders. Since preference shareholders are given a fixed rate of dividend, equity shareholders get higher dividend. Fixed obligations. Preference shares do not impose excess burden on the company because only a fixed rate of dividend has to be paid, and that also if the company makes profit. Moving on to the next advantage, there is no dilution of corporate control. Since preference shareholders do not usually have any voting right, there is no dilution of corporate control by existing equity shareholders. The next advantage would be no charge on the assets of the company. By issuing preference shares, a company can raise funds on a long-term basis without imposing any claim or charge over its assets. Moving on to the next advantage, creditworthiness. Since preference capital is generally treated as part of net worth, the credit worthiness of the firm is enhanced. Moving on to the next advantage, no legal obligation. There is no legal obligation to pay dividend to preference shareholders. Even if a company skips dividend, it does not face bankruptcy. Let's move down to the last advantage of holding preference shares. Redemption of preference shares can be delayed without significant penalties. Now, students may argue, sir, you gave so many advantages. Are there any drawbacks? Answer is yes. Let us look into the first drawback. And the first drawback is grouping of voting rights. Investors generally do not like preference shares as they have restricted voting rights. However, if a company skips dividend on preference shares for 3 years consecutively, it has to grant voting rights to preference shareholders on matters which affect them. Moving on to the next drawback, loss of exclusive right. In case of excessive use of preference shares, the equity shareholders lose their exclusive rights over the assets of the company. Let's move on to the third drawback, which is loss of flexibility. Now, what do we mean by this? The issue of preference shares restrict the flexibility of the company in certain cases. Moving on to the next drawback, which is high cost. Preference capital is more expensive source of finance than debt capital. Why? Because the dividend paid to preference shareholders is not a deductible expense for assessing a company's tax. Let's move on to the next drawback, which is loss of corporate image liability. Now, what do we understand by this? A company does not have any legal obligation to pay dividends to preference shareholders. However, skipping dividends may adversely affect the market image of the company, mainly its image in the capital market. Moving on to the last drawback, which is prior claim. Compared to ordinary equity shareholders, preference shareholders have a prior claim on the assets and earnings of the firm. Now, students, let us move on to the next slide, and this is called as retained earnings. A lot of you take accountancy as one of the subjects. Now, when we talk about accountancy, we always talk about retained profits. Now, in the retained profits, we say that, let me move on to the next slide. It is a part of the profit which is transferred to the reserves every year, and it can be retained or reinvested in the business for its modernization, expansion, etc. Now, reinvestment of undistributed profit is a very good source of business finance. Now, interestingly, we think that retained earnings is a very powerful tool in the hands of accountants. They usually try to boil more and more retained earnings in the company because they have this feeling that it will increase the market value of shares. Now let us look into some of the advantages. The first one would be economy and simplicity. It is perhaps the most economical method of raising funds because such funds are generated in a virtually costless fashion, and the procedure for raising funds is very simple, smooth, and easy. Let's move on to the second advantage of retained earning, which is no fixed obligation. The company is not under any obligation to pay either fixed interest or dividend. Moving on to the third advantage, no need to offer any kind of security. Raising funds from internal sources does not require mortgaging any asset or security. So it is just like an unsecured loan. Moving on to the next advantage, which is financial strength. Retained earnings make a company financially strong and viable. It increases its credit worthiness and enables it to make new public issue as also to borrow from the public and financial institutions easily and quickly. Let's move on to the next advantage, which would be increasing the market value of the organization. Retained earnings serve to increase the value of the company to the shareholders and increase the shareholders' capital by adding to revenue reserves. Now, students would have a doubt. Are there any drawbacks? Are there any disadvantages? And the answer is yes. The first advantage is misuse of funds. The management of a company may misuse the funds retained by recklessly investing them in unprofitable ventures or by making wasteful expenditure. The other drawback would be overcapitalization and its abuses. Now you'll say, what do you mean by this? Management may utilize retained earnings for issuing bonus shares to equity shareholders. And this is likely to lead to overcapitalization with all the adverse consequences. Moving on to the third drawback, greater concentration of control. By retaining earnings as a routine affair, a company can manipulate the prices of its shares with a view to enable its existing directors to acquire more shares. And this may lead to undue concentration of corporate control in the hands of few people. The last drawback of retained earnings would be unhappiness of shareholders. The existing shareholders feel dissatisfied when they get low dividend due to high retention of earnings. So, thank you children. I will catch you up in the next video where we will talk about borrowed funds in detail.
Okay.